Hey, hello, welcome everyone. We are just letting people enter, so give us a couple of more minutes before we start, as people are still trickling in. But thank you all for being here. We're very happy to have you with us, and we'll begin in just a minute. Great. I see we have quite a few people who have already joined, so I think we can get started and people will continue to join us as we go through. So again, thank you everyone for being here and welcome. My name is Anar. I lead the insurance work at CGAP. I will be co-moderating today's session along with my colleague Krishnan from the UNCDF. So for those of you who are unfamiliar with CGAP, we are a member-based organization. We're housed at the World Bank. Our mission is to improve the lives of people living in poverty through financial inclusion. And we do this by generating knowledge, by sharing insights, and really at the intersection of policy and markets. And we're trying to help financial systems serve the people that need them most. And that's what our session today is about. We're here to explore how insurance solutions from the household level to the sovereign level can work together as a connected system. So sometimes we get the question on what is better, sovereign risk insurance or retail insurance. And our objective today is to show that these solutions are not mutually exclusive. It's not a question of either or, but how do these solutions actually complement each other? And we would like you to leave today with a better understanding of how these layers should reinforce one another. So today we've organized this session around 3 panels. Over the next 60 minutes, we'll work through 3 sessions. One will look at micro-level risk transfer. The second will look at sovereign level and humanitarian level insurance. And then the third will look very importantly at the question of how do we connect these layers and what it takes to make these systems work together. So before I introduce our speakers, I want to hand over to Krishnan to say some opening remarks on behalf of the UNCDF. Krishnan, over to you.
Yeah, thank you very much, Anar. Very good morning, very good afternoon to the speakers and to the participants. My name is Krishnan. I lead the work on climate disaster risk financing and insurance with the United Nations Capital Development Fund. UNCDF is a very specialized agency within the UN system, mandated to be the development finance agency for the UN and its member states, with a specific focus on least developed countries, small island developing states, and countries in fragile contexts. UNCDF is the only agency, with the exception of IFAD, that has the mandate to deploy a range of financing instruments like guarantees, concessional loans, grants, and other de-risking instruments to both the public and private sector. So climate risk insurance is a growing body of work for UNCDF, integrating these instruments that I just mentioned. The background behind, of course, we are a member of CGAP, and it is always good to collaborate with CGAP on a good initiative like this. The background behind this particular webinar is that under the G20 presidency of South Africa last year in 2025, UNCDF was a knowledge partner under the Disaster Risk Reduction Working Group and was tasked with collaboratively developing a compendium on risk transfer solutions. This G20 2025 publication covered several case studies and solutions at the macro, meso, and the micro levels from different countries, both members of the G20 and others. This particular compendium was extremely well received, and this webinar and the ongoing dialogue that we are having with a range of partners on this topic is intended to continue the foundational work that was done earlier and for deepening the engagement both at policy and practice levels. With this as background, I would now like to hand over back to Anar to go ahead with the session and thank all the speakers and participants for their keen interest and support to this webinar. So over to you, Anar.
Thank you very much, Krishnan. So we have a great set of speakers here today. I'm happy to introduce them. So we have Isaac, who is the Chief Executive Officer of CRIF, Anna, who is Head of Crisis Anticipation and Risk Finance at the START Network, Elias, who's Principal Sustainable Insurance at FSD Africa, Panay, who's Head of Climate and Resilience at Hiscox Re, Mfo, who is Business Head, Rest of Africa and Parametric Crop Insurance at Santam Specialist Solutions, Lapani, who is Manager of the Insure Resilience Solutions Fund project at the Reserve Bank of Fiji, and myself and Krishnan, you've already heard from, who are moderating the session. So with that, I would like to get us started. You can all put your questions in the chat as we go through the session, and we'll take them at the end. So Lapani, I want to begin with you. The Reserve Bank of Fiji has taken a significant step. It's a central bank which is actively driving micro-level insurance uptake, working with local distribution partners and government ministries. Can you tell us about the program and why the Reserve Bank of Fiji took on this role?
Thank you, Anar. Bulavanaka, everyone from Fiji. As Anar mentioned, my name is Lepani Ulinaviti. So basically on the question that you've asked today, so the Reserve Bank of Fiji's leadership of the parametric microinsurance program reflects the evolution of its role over the past 2 decades from a traditional central bank focused on monetary policy, financial stability, and currency management to one that strongly promotes financial sector development and financial inclusion. So for us, this is our third financial inclusion strategy that currently running, which is aligned with the UN Sustainable Development Goals. And the RBF has a mandate to ensure that all Fijians, particularly the vulnerable and financially excluded groups, can access affordable and appropriate financial services. So this for us includes developing financial solutions that strengthen resilience to climate change. Given Fiji's high exposure to cyclone, floods, and other climate-related disasters, coupled with extremely low climate risk insurance coverage, the RBF saw the opportunity to lead the parametric microinsurance program implementation as a natural extension of its financial inclusion mandate when it was approached by the UNCDF PCAP in 2023. So the bank was uniquely positioned to coordinate efforts across government ministries, insurance, development partners, and community organization while maintaining a clear separation from its regulatory and supervisory function. So for us, the program, the results over the last 2 years speaks for itself in terms of building on from the pilot implementation from 2021 by the UNCDF PCAP. It demonstrates significant demand and impact. So against an initial 2-year target of 5,000 new policyholders or households that were to be covered, the program reached approximately 4,200 policyholders in the first year and 8,500 policyholders by the end of the second onboarding cycle. So starting from the baseline of around 1,200 policyholders, more than 7,000 additional household farmers, fishers, and MSMEs gained access to parametric microinsurance over the 2 years, with women accounting for more than 50% of total beneficiaries. So the program also demonstrated the value of insurance in practice in terms of payout. So in year one, 1,100 for the program, 1,101 households received payout totaling 107,000 Fijian dollars or close to 50,000 USD. While in year two, the number of households that received payouts increased to 2,024, with more than 60,000 USD total payout, providing support following climate-related events. From a product development perspective, given that it's a small market and we're trying to scale existing products, focus on new product has been on the needs or target groups that have not been met. And for this purpose, the partners under the lead of the UNCDF PCAP will be launching next week the MSME parametric microinsurance product cover, and we are also working with UNCDF on an investment package that will also look at leveraging the existing credit guarantee scheme and other premium subsidy scheme that we've put into place. So what the program highlights for us in terms of there are several gaps that for us as the Reserve Bank that we are uniquely positioned to address. One is the coordination gap. So building on from the ecosystem that was established by the UNCDF PCAP in the pilot phase, and using our convening power, the RBF is able to bring together, these key stakeholders that builds the ecosystem around this common objective of scaling up parametric microinsurance. The product innovation gap, so for us in terms of supporting the development and the scaling of simple, affordable parametric insurance product to vulnerable communities. So the solution was actually first piloted in the fintech regulatory sandbox that is also administered by the Reserve Bank of Fiji. The third gap that we looked at was trust and awareness. So many households had limited experience with insurance and low understanding of how it works. So the RBF financial inclusion mandate allowed it to lead consumer awareness and financial education efforts, helping communities understand the value of insurance protection. Distribution gap, this is what you understand that, working through the ministry's cooperative association and community network, because for insurers themselves to reach the rural and maritime population, it can be costly. So this is part of the work that we do to clog that gap also. And lastly, on affordability, so together with our grant partners, we also committed over the 2 years of the program, we committed more than USD 200,000 in terms of premium subsidy in order to push the scale up. So for us, the RBF role has been, part of market builder and as a catalyst in terms of continuing the work that was done by the UNCDF PCAP and, helping create an inclusive climate risk insurance market. And an important lesson was that, for us is that market development and regulation cannot be separated. In terms of innovation without appropriate oversight can undermine trust. But also on the other side, regulation without innovation can leave vulnerable communities excluded from protection. So our role, therefore, was not simply to regulate products, but to help create the condition under which insurers, distribution partners, and communities could participate confidently. And more broadly, for us, this highlights the role government and regulators play in connecting the different layers of disaster risk financing. And the effective microinsurance requires supportive policy, strong institution, and links to wider national resilience and disaster financing strategy. So for us, the broader lessons is that financial inclusion is not only about access to savings and credit, it is also about financial resilience. And by helping vulnerable households, access insurance before and after disaster occurs, the RBF is strengthening both household resilience and macroeconomic stability, an objective that sits squarely with the central bank's long-term interest. Thank you, Anna.
Thank you very much. I think it's really great and really inspiring to see the role that a central bank could play in delivering and designing this program. You've touched on all these points, but could you say a little bit more, since we're talking about connection here today, that which local actors were most important in connecting risk transfer solutions directly to vulnerable communities, climate exposed communities and households? And what did these actors really do to make that product trustworthy, accessible, and usable before a shock? And you've touched a bit on these points, but it would be great to hear a little bit more.
Yeah, thank you, Anar. In Fiji and across the Pacific, one of the key lessons has been that, insurance product, particularly for parametric, since the implementation of parametric microinsurance in Fiji, that it do not reach the vulnerable communities on their own. The most important actors were those already embedded within communities and trusted by the peoples or groups that we were trying to target. So this included the mobile network operators, the financial institutions, the cooperative, employer groups, even community organization, and government-supported group program. So they acted as the bridge between the insurance providers and then the end users in terms of the beneficiaries. And for us, the key model that we found that has worked for us in terms of the aggregated distribution model. When we have two insurance companies that are providing this parametric microinsurance product in Fiji, and when we compare the two, one has the aggregated distribution model and one is a direct distribution model. But when we look at how the effective that was in terms of reaching the vulnerable communities and getting them to be onboarded, we found that the aggregated distribution model was and working with the partners was more effective. So their role in terms of when beyond distribution, they also helped explain how parametric insurance worked. They assisted with enrollment. They collected feedback and built awareness about what people could realistically expect from the coverage. So in many cases, they also translated technical insurance concept into language and example that communities could relate to. So trust was particularly important because for many of the household and MSMEs I mentioned earlier, insurance was that we had in terms of the target group that we're looking at, insurance was completely a new concept. Or where you've created awareness in the year before, when you go in the second year, it's still the full understanding of how the insurance work is not there. So people were willing to participate because the information came through organization that they already knew and trusted. From a risk financing perspective, so they are, most of you would be aware because you are expert in this area, they are the meso layer. So they are the connectors between the risk capital and the vulnerable population. So they enable microinsurance to become accessible and usable long before a disaster occurred. So for us, this, and for the purpose of the discussion today, this demonstrates an important point in terms of while the micro level risk transfer protects individual and businesses, its effectiveness depends heavily on local institutional networks that help connect people to insurance and ensure benefits can reach them quickly when disasters occur.
Thank you very much, and again, thank you for being here because it's the middle of the night for you, and I see your intervention has already sparked a lot of interest, and we have some good questions in the chat, so we'll come back to those at the end. But for the moment, I want to move to you, Mpho, in South Africa to hear a little bit about Santam's experience. And so Santam, one of the things that I found very interesting is you're not just providing insurance, you're actually helping design a disaster risk finance strategy at a national level that uses government distribution as part of a broader public-private partnership. Can you tell us a little bit about what that means in practice for a private insurer to play that role? And how do you navigate the boundary between public interest and commercial needs?
Right. No, thank you very much. And I'll provide a little bit of context about Santam before then diving into the specifics of the question. And I think the context will provide more information around the initiative that we're rolling out and why we're rolling out that particular initiative. So Santam is a lead private insurance company in South Africa and hold a significant market share in various lines of insurance business. And from a gross written premium perspective, the company is the largest insurer within the African continent. We've been operational for 108 years. And what that means is that over the period, we've built substantial capability when it comes to underwriting, pricing, product distribution, technology, data, and human capital capability. So all of that capability put together actually creates Santam as a catalyst to drive solutions for resilience in South Africa, particularly focusing on the agricultural sector, which is disproportionately exposed to climate-related risk. So in collaboration with government in a classic public-private partnership model, where government provides capacity in terms of coordination. We provide our skills, our expertise in insurance to drive better distribution models that improve overall resilience. So in summary, we see ourselves as an actor that is coordinating and driving change for a more resilient ecosystem. When it comes to the last component of your question around balancing public interest as well as commercial interest, I think the balance there lies in alignment. From a government perspective, there is a need to reduce disaster risk and to move to more pre-arranged risk financing mechanisms. And from an insurance perspective, there is a drive from private insurance companies to create sustainable insurance markets. And through that sustainability, I think that is where the balance is found, because mutual outcomes are driven because of the different perspectives and the synergies that come from collaboration.
Thank you very much for sharing this. And another thing that I was really keen on hearing from you is, from the perspective of a local insurer, when you look at building solutions for low income and MSME clients, both in South Africa and in the region, it's really a long-term game. So what are the incentives for Santam to be engaged in this business? And how do you think about long-term sustainability?
Yep, absolutely agreed. It's a long-term game in nature. And how we look at it is that resilience ultimately translates into the next pathway, which is growth. When farmers in particular are more resilient, they become bankable. And from a bankability perspective, that is likely to translate into better access to credit. So in effect, you're creating more consumers that are sustainable and commercially viable. And from that perspective, the thesis is that there's likely to be growth in overall insurance markets as consumers start engaging more sophisticated insurance products, and ultimately that creates commercial viability. So the long-term view is ultimately to support the market from a market development perspective, and for that market development perspective to be self-sustaining in the long term through commercial fundamentals.
Thank you very much. And I hope we have other insurance companies on the line that are listening to you and that will be inspired by your case to also develop this kind of business. So I thank you both for getting us started here today. I think that what really strikes me across both your contributions is that resilience needs to be locally led. We can't just have systems that are designed by international actors very far away from the realities on the ground. It really requires locally led action, products to be designed from the ground up, and institutional actors like local insurance companies, central banks that are really working on last mile delivery and that are connected to the communities that are benefiting from these solutions. And then at the same time, we know that retail solutions are not going to necessarily be enough in all cases. Household level products may not be sufficient to absorb catastrophic losses. And that's where we might need sovereign level or humanitarian level financing to come in. And that's what our second panel is going to look at. So I'm going to hand over to Krishnan to take us through that discussion. Krishnan, over to you.
Yeah, thank you very much, Anar. I think we have seen quite a lot of interesting responses by the first two speakers, one from a small island developing state and one from a fairly advanced country. But then, my experience of being in South Africa last year during the various G20 meetings was that there is also a big divide within South Africa, as would be confirmed by our friend from Santam. And then the perspective that he gave on behalf of Santam about the public-private partnerships was also quite, was quite important. It also highlighted, both speakers highlighted how micro-level insurance penetration depends on the ecosystem to be robust, how it depends on the local actors, the capacity of the local actors, the regulators to work with the local market actors, as well as insurers and reinsurers, to make protection accessible and trustworthy. But we also heard that there is a role for governments to deliver insurance solutions that need to manage their budgets. Because whenever there is a catastrophic event, there is expectation that government should respond. Uh, that raises a very big question, is that when the risks exceed what can be addressed at the micro level by the households or local insurers or national markets can manage, where do and how does sovereign, regional, and humanitarian mechanisms that can provide rapid liquidity and can step in, and how that liquidity can connect back to people through meso and microsystems, and whether it can connect back through meso and microsystems. So in this section, I would like to first go to Isaac Anthony, the CEO of CGAP SPC. So Isaac, thank you once again for being on this panel. And my first question to you would be, how should governments think about sovereign or regional insurance within a broad risk layering or disaster risk financing strategy that also includes micro level protection, meso level delivery systems, social protection, and humanitarian response? So, Isaac, over to you.
Well, thank you, Krishnan. So, yeah, so indeed, the sovereign parametric insurance, I must say, is really one layer in a broader or wider disaster risk financing architecture. It is really not a standalone fix. It is really built for high impact, low frequency events to absorb, what we call the large covariate shocks. That is the economy-wide events where losses sometimes range between 40 to 60% of gross domestic products, such as what we saw with Hurricane Beryl in Grenada in the year 2024 and Melissa in Jamaica in 2025. That no household, no local insurer or national budget can carry alone. Indeed, in smaller economies, natural hazard events can result in losses of more than 100% of a country's GDP, as we've seen in many countries in the Caribbean, including Grenada, which was impacted by Hurricane Ivan in the year 2004, which actually provided, in a sense, the inspiration for the establishment of what was then known as the Caribbean Catastrophe Risk Insurance Facility. Sovereign parametric insurance it is important that it must be layered within other disaster risk financing instruments that addresses both higher risk, example, what you call the cat bonds, which you've been hearing a lot about now, and the lower risk, such as contingent credits or dedicated reserve funds. And it must also really sit alongside the micro level protection and meso level delivery system, the social protection, and the humanitarian responses, as the previous speakers have already highlighted. Governments really should think in terms of who each layer is best placed to protect. Sovereign and regional pools provide quick liquidity to governments while supporting macroeconomic stability by protecting fiscal space and minimizing the use of debts. Micro-level products, on the other hand, protect individual livelihoods, while the meso system provide protection, social protection. Cooperatives, aggregators are really the delivery mechanisms that move liquidity to people. Each has, in a sense, a distinct job. So it is really important for us to really think about who we're really looking to protect. Governments should treat sovereign parametric insurance as the first response liquidity layer, buying time while slower reconstruction financing, such as loans, grants, indemnity insurance, would come online. The layers only reinforce one another if they're deliberately connected. CRIF's model shows this. For example, countries that layer parametric insurance with contingent credit, reserve funds, and cat bonds recover faster and more equitably than those relying on DRF instruments or post-event borrowing. An excellent example of this was Jamaica, which bounced back relatively quickly from the impact of Hurricane Melissa in 2025, with losses accounting for about 58% of GDP. In addition to the $92 million that I'm talking about US dollars that the government of Jamaica received from CRIF as a payout, they also received $150 million from the cat bond, which triggered in full. The government also was able to access $300 million from its contingent credit facility from the IDB to support long-term reconstruction. So it is really important for sovereign insurance to be seen as part of a broader risk layering strategy, given how significant the protection gap is. And just to say, and by saying that the various instruments and the other disaster risk financing instruments must be seen as complementary if we are to close the protection gap. So it does provide resources for the government, who itself has a responsibility for providing support for social protection and helping to support the wider economy, but making sure that we have instruments such as the micro products, the meso, that can provide more targeted support to the individuals. Thank you.
Yeah, thank you very much, Isaac. I think these are fantastic examples of what we were actually looking for to come out from this webinar. And, like CRIF itself has this great track record of fast, timely payouts, as you mentioned recently for Melissa to Jamaica. So I would like to ask you specifically, are there any concrete examples or data from CRIF's experience over the last so many years that show how sovereign payouts have supported ground level response or recovery beyond just budgetary relief? Over.
Absolutely. The record is actually quite significant. And since 2007, when CRIF was established, we have made payouts of about $483 million US dollars across 82 individual payouts, with every payout, as you quite rightly acknowledge, made within 14 days, every single one of them, including the recent payouts to the government of Jamaica following Hurricane Melissa, where that country was able to access $92 million from CRIF, again received within a period of only 2 weeks. And CRIF track where the money goes. So that is really important. So we don't just make payouts, but we also track exactly where the money goes. And what we've seen is that roughly 60% flows to immediate post-event response, which would include clearing of roads, restoring services such as water and electricity, providing food, medicine, home repairs to affected persons, with another 19%, approximately 19% to longer term reconstruction. And we have some more examples in the case of Grenada, again, which was impacted by Hurricane Beryl in 2004, where that country received total payouts of about $55 million from CRIF across governments, electricity, water, and the fishery sector. The funds were used to, for example, to restore power to over 19,000 customers, rebuild water system for the satellite islands of Carriacou and Petit Martinique. It helped nearly 5,000 farmers and hundreds of fisherfolk to restart their livelihoods, in addition to the support provided to affected households to repair homes. We saw again in the case of Jamaica, which again was impacted by Hurricane Beryl in 2024 and Hurricane Melissa in the following year. Payouts were used to clear more than 600 block roads, reopen access for cut-off communities, And after Melissa, Jamaica received that payout from CRIF, the largest payout in our history. And it was again used, a significant portion of it was used for social protection, for utilities, for MSMEs, to recover, to reconstruct hospitals and schools. Again, we saw cases where reaching out directly to households long before specialized instruments existed. For example, after the 2018 excess rainfall event in Trinidad, payouts were used to deliver building materials and appliances to affected families through the Social Development Ministry. We saw, for example, payouts used for water and electricity in the case of Grenada, as I mentioned earlier, and humanitarian responses, again in Trinidad. Payouts were used for building materials, appliances, relief. So we see there's quite a lot. And again, I can even mention that after Hurricane Beryl, through the CRIF World Food Program top-up in St. Vincent and the Grenadines, they were able to issue over 4,600 social safety net payments and supported 5,670 farmers and fishers after Beryl. Jamaica reached over 11,000 economically vulnerable people via the Ministry of Labor and Social Security. So again, we see how that CRIF has been able to make those payouts, but we've been able to monitor very carefully how those payouts are being used, because the countries are also required to submit a report on the use of payout within 6 months of each event. And that really gives us the ability to be able to indicate exactly how funds have been used. So it's very clear that it is actually working. Insurance is working at all levels, and certainly CRIF continues to play a very important part in that regard. Thank you.
So Isaac, thank you very much. I think it is very heartening to hear, your words saying that insurance works or insurance is working. And then you gave some fantastic examples of how this rapid payouts has been in turn used by the recipient governments for their immediate recovery efforts. Because we are talking about countries that don't have big fiscal spaces, and then these are typically small economies that need this sort of support, and the critical role that the CRIF has been playing in supporting through sovereign parametric insurance has been extremely well brought out through your examples. Thank you very much for that. And I think I will, on this note, move to the next speaker from the humanitarian sector, Anna. Thank you very much for being with us in this webinar. So Anna represents the START Network. START Network, Anna, uses both insurance and anticipatory action with different, the timing of which instrument is used differs by the hazard, as we understand. Drought triggers are fully anticipatory, while cyclone responses may be a little ahead of the landfall, before or after, immediately thereafter. How do these tools complement each other, and how would you decide which instrument to deploy for which market or for whom and when, especially to avoid duplication with other government-led responses? Anna.
Thank you. Thank you for the question, and thanks for having me. I would like to bring a slightly different angle into the conversation, which I know is very focused on financing, and I have a financial background myself, so I'm very much into this. But so I feel that very often discussion about risk transfer focus only on financial instruments. And so we compare the different type of insurance, macro, micro level, meso level, catastrophe bond. But what we want to say is that people do not experience disasters in different layers. They experience them in one event. And when we design system, we need to work through the instrument starting from the need of the people. So risk layering presents a menu of different financial instruments, and each of them cover a different level of risk. So this is useful from a financial perspective. From our point of view, I think the main question is, what are the needs that vulnerable people experience before, during, and after a shock, and according to the different severity of the shock. So we want to move the attention from the instrument to the needs first. This helps us to structure a consortium of different instruments that can go well together to address these needs. So we know that people experience needs before the rise of a certain disaster, during it, after, immediately after, and then in the long term for recovery. We feel that insurance, as my colleague Isaac said, needs to be looked into a bigger picture. So insurance is not a silver bullet, cannot work in isolation, needs to be part of a continuum of funding that go to the community needs. So we work a lot with insurance at Star Network, but we complement it with the anticipatory action and preparedness products, and also with later recovery funds and immediate response. So we are very much focused on the risk layering that analyze the different stages of the people's needs from before the season, where people need to be prepared for what is coming. Local communities, local organization needs to know what could happen in the future, in the next few months. I mean, they already know because they live there, but they also need to be comfortable that the warning that we'll receive will be trustful. They have to be comfortable that the work that NGO will try to do really provides support to the communities. So we start working with communities very early on. And then the type of work continues through anticipatory action. And anticipatory action usually doesn't use a lot of insurance systems mechanism yet. It uses more contingency funds. So we use our internal contingency funds mechanisms such as Star Ready, which deliver funds at the specific trigger. So the few days before a crisis is happening, we can reach people and provide them with support to allow them to better cope with the imminent risk. This also depends from the type of risk we are considering. If we talk about very quick onset crises like flood and cyclone, anticipatory action usually happen few days before. If we talk about a crisis like drought, anticipatory action can intervene much earlier. So that helps people to really work for months before the imminent drought to prepare themselves and to be able to better cope with the dry season that is going to happen. And then insurance products link very well with this anticipatory action approach, because they will be there to basically address the residual needs that will still be present once the risk has happened. So if we intervene in anticipatory action for a cyclone, we can evacuate people. We can help them to protect their livelihood. We can help them to remove their assets and bring them with them, to protect their houses with special reinforcements. But we know already that after the cyclone, there will be needs that are still present. So anticipatory action won't be able to eliminate completely the impact of the crisis. It will reduce it, but not eliminate it. So insurance is a pre-finance instrument that ensure people that funds will be there once they go back to their houses, when there is the need to reconstruct their houses, when they need the cash, immediate cash, because they cannot go back to work immediately. And the two things go very well together, because people have reduced their exposure to the risk, and at the point they go back, they will have resources to recover from the risk that has happened. So we really see anticipatory action and insurance as two instruments of one single system, and the fact that they provide different type of support at different time in the cycle of the crisis is really the key point of using all these different instruments. On top of that, insurance sometimes kicks in when crises are particularly strong, where basically governments or humanitarian actors cannot hold the risk because it's too large to be held by a single actor. So the risk is shared with the private sector. So even in that case, we see that the complementarity of the instruments, because we can trigger our funds for like small to medium-sized crisis, but then big amount of money needs to come in when the risk is really severe. We see this happening very well, for example, in Zimbabwe, where we deal with drought. We trigger already our anticipatory action mechanism on the seasonal forecast, so a few months before the dry season, and this help organization to work with communities to preposition resources, to allow them to be trained on the way to cultivate the land during a dry season, to improve the agricultural system, to protect their livelihood and their livestock. And then we work with as a replica partner as part of ARC, which is the African Risk Capacity Scheme, which usually triggers after the drought has settled. And the two mechanisms really work well together because they provide a continuation of funding through the crisis, which obviously for a family is very important because they know that they will not be left alone during this difficult period. And so with one instrument, we prevent the drought. With the other one, we mitigate the food insecurity that has been caused by the drought.
Yeah, so thank you very much, Anna. I think, you did cover more than what I posed you as question. But what we have heard in this segment is a very clear examples from a regional risk pool giving rapid liquidity to its member states, and more importantly, how this money is being used for fast recovery. At the same time, acknowledging that meso and microsystems are also required to take care of certain things that are not covered at the sovereign level. And we also heard from Anna the impact of what the humanitarian response, both anticipatory and post-event, can do, and how they are really complementary. They are two sides of the same coin. When one instrument will lead to better preparation for an impending disaster, whereas the other instrument will take care of their recovery post-disaster. These are excellent examples, and this actually leads this leads well to the next segment, where we should, while we have seen examples of rapid liquidity is definitely required, but just not sufficient. And the instruments that were discussed so far, they become really protection instruments only when the payout use, proper targeting, delivery mechanisms, and accountability are decided and advanced in advance and agreed. On this note, I will hand it over to Anar, and in the interest of time, we will move to the next segment. Over to you, Anar. Thank you.
Thank you very much, Christian, and I think you've summarized well what we've heard so far, so I won't repeat that. I think what we want to go into now in this last segment is how do we bring this all together? What is connecting these micro, meso, and macro levels? I think Anna started to speak a little bit about, the risk not being able to be borne by any single actor or any single layer, and this is where we want to get into a bit more detail. So Elias, you've been very patient, and thank you for being here with us. I want to turn to you now and actually ask you from FSD's work, why do meso, macro, and micro solutions sometimes remain fragmented, even if they're looking at addressing the same risk? And what is needed in market infrastructure to make these layers work together more effectively?
Right. Thank you very much, Anna. And we are privileged to be in this particular session and really to share some of our insights on what we should be able to do. As has been mentioned with our previous speakers, if you think about climate and disaster risk finance, most of the time we describe it in layers, and that is something that has have been mentioned by the previous speakers, whereby you see from the sovereign instrument side trying to protect the public balance sheets to the meso level mechanisms, looking at how then you can structure institutional support and aggregators to the micro level, whereby then you see a lot of protection to the households. But in practice, if you look at how all of those instruments have been designed, and also how they have been how they are being financed, how they're being regulated, they're implemented very separately, and that really shows a big issue around fragmentation, particularly when it comes to how then you respond to shocks or disasters. So the central issue here is not absence of risk transfer products, because as it has been mentioned by previous colleagues, there are a couple of instruments that are already existing, and there's a big pathway in which these particular instruments are addressing those particular issues. But the issue is about an architecture that is missing, and that is where we really need to think about. And what you've asked, why is this the case? Why do we see fragmentation across these layers? And I'll basically pick four major issues that we really need to solve, and then thereafter maybe think about what are some of the things that we really need to kind of respond to those fragmented areas. One is around the separate institutional mandates. If you look at how sovereign risk instrument has been typically set together, particularly being driven through the ministries and governments, and also how then the meso instruments are being put through, particularly through regional risk pools. It means that the people that are primarily required to address and to support that architecture sometimes are left out of the picture. Think about insurance, think about development partners, think about distribution platforms. All of these elements are coming from different mandates and different setups, and that's something that really needs to be connected. The second element that maybe we might need to also think about broadly is misalignment on data, particularly the data that is used to address these particular disasters or these risks. So you kind of see we have different models, we have different indices, different payouts, given that all of this is trying to address the same risk. So misalignment on how then we respond and how then we look at data, including the models that are built to support people, governments or institutions. All of these are coming in separate levels. The third is around fragmentation, particularly from the regulatory oversight. You'll be able to see that if you look at the physical, also the insurance and disaster risk authorities, they don't speak to each other. Each and every regulatory or policy maker have a different role and a different way in which they are looking into addressing risk. So in this particular case, then there's need for us to think about a coordinated national architecture around how then we address climate or disaster risk financing across the different regulatory authorities. And lastly, I think it's around lack of shared view of risk. There's no common understanding of how then we retain risk, how then do we transfer risk, also how then do we look at how we make decisions on the risks that are currently uncovered. So this kind of leaves very huge gaps, particularly when it comes to decision making, and also even overlaps in terms of the decisions that have been made. And the question is then, do we really respond to the value of money? So as FSD Africa, I think our work mainly looks at how then we build market infrastructure. And that is what is really missing in terms of connecting elements. So if you think about it broadly, we need to kind of develop a coordinated market infrastructure that will reduce all this fragmentation, but also enable programs to be designed as a one system. I'll give a couple of examples of what we've done, and these are not exhaustive. I believe that as institutions that are having a mandate to close the protection gap, we have a role to play. So, for instance, there is need for us to think about a common data risk framework, particularly when it comes to ensuring that all the layers that we are trying to address, particularly when it comes to resolving hazards or exposures or vulnerability, that is coordinated in a one platform component. There's also need to think about how then we ensure there's iterability when it comes to data and issues around the triggers, because then if you think about index insurance, we have sovereign index insurance products, we have meso index insurance product, but also micro insurance products. So the key thing, index insurance product, but the thing is then, are these layers in terms of the trigger of these indices, are they coordinated, and the expected payouts, can it be able to kind of support the existing infrastructure in such a way that the risk is reduced across the three layers. The third thing is around having a coordinated reinsurance, but also retrocession, because if you look at the gaps around capacity, the gaps around pricing, the gaps around the demand, and the capacity of different markets, there is need to really look at how then we address the reinsurance markets and create instruments around it. And lastly is the delivery rails. So if you look at how then we deliver our risk transfer solutions, there is no coordination around delivery, given that they are still tending to address the same risk. So how then do we coordinate around, think about the digital infrastructural systems, working with innovators, working with insurtechs, working with aggregators, working with cooperatives, just to ensure then the payouts reach the beneficiaries quite quickly and transparently, but also how then do you ensure that these beneficiaries use their payouts in the right channels. So maybe, and all of that, then the question is, are we having regulatory alignment? Because I mentioned regulations as a key thing. Are we able to see alignment across financial ministries, finance ministries around, think about disaster management agencies, think about insurance agencies, to have a central enabling, a central coordinated to enable the infrastructure to function. And that is something that without even coordinating the regulatory alignment, then we'll be able to see a lot of gaps still within the coordinated infrastructure. Maybe I'll be able to share a few examples if time allows. If there's maybe I can share maybe 2 examples of how then we are looking at the market infrastructure. So if you look at it from the interoperability side, FSD Africa has been keen in terms of how then we build that market infrastructure. So the issue around capital is not a problem in most continents that we are in, but how then do we enable that capital to flow? So for instance, we've been working with the private insurance markets to set up an inclusive insurance insurtech fund. And this is what I call a purpose-built capital around developing what we call a capital market infrastructure that will enable aggregators to get capital to address the risk that most of the time the industry might not really be willing to address. And that kind of creates an opportunity for the private sector to put their capital into play to support the vulnerable communities. And this is a significant market infrastructure that kind of channels capital to the people that need it, but also ensuring that that capital is utilized to address the risks that most of the time have not been addressed in the past. The second thing is around the meso coordination. So we've been working with other agencies. So for instance, we've been working with the MasterCard Foundation really to develop a meso level coordinated design that really focuses on thinking about agriculture as a value chains product rather than a small dollar product. And what do I mean? What do I really mean by that? If you think about solutions from a value chain risk management perspective, then this changes the ecosystem in terms of how you deliver the product. And I did mention the delivery rails that really needs to be built. So you kind of bundle the insurance solutions with the right financial tools that gives them an opportunity to address the risk that they're currently experiencing. So you think about the climate risk or disaster risk as a financial instrument across the ecosystem. So how then do you increase adoption of these risks, increase adoption of these financial products by bundling them with credit, bundling them with training, such as climate smart, but also building the capacity of institutions. So through a shared data infrastructure and also building the entire insurance ecosystem. So that is a well-coordinated meso level design. Then lastly, also maybe talk about reinsurance, whereby we are currently working on an instrument that focuses on building, on unlocking capacity for the reinsurance market to provide solutions for the risk that most of the time do not have enough capacity to be reinsured across the African continent. So we've developed Surge Africa that really looks at enabling capital to be placed towards reinsurance, and various owners of capital can really put in their money to ensure the underwriting of these risks to be insured across the African continent. So this is first of its kind, whereby we intend to build a specialist underwriting capacity that will drive appreciation of risks such as green risks, climate risk, which most of the time have been quite a big challenge to insure across the continent. But also lastly is around really looking at how then do you support the climate adaptation and resilience plans across different cities across the continent. So for instance, we've been working with commercial financial sector stakeholders to introduce what we call market-based instruments that address some of the prevailing risks within the city. So for instance, building a flood risk resilience management system that enables the private institutions to invest in instruments that will create resilience within the public infrastructure, which most of the time is heavily exposed. So I'll pause and maybe get to hear more from you, Anna, in terms of your next question.
Yeah, thank you very much, Elias. You've touched on a lot of important points, and especially on this ecosystem approach of how you bring different actors together and how you can mobilize private capital. Maybe my last question for you will also be on the public sector. And what do you think that public sector needs to invest in to enable the connectivity and enable this ecosystem approach? And if you could maybe touch on this briefly, as we're very close to out of time here.
Yeah, so the public sector has a very big role to play, because I did talk about what the private sector really needs to provide, because private sector will provide the operational backbone around this architecture. But in terms of enabling the efficiency within the architecture that kind of connects these three layers, that is heavily enabled through the public sector. So think about it. We've seen the public sector providing what we call premium subsidies, that most of the time they look at how then do we stimulate demand, how then do we ensure that we enable affordability, but that cannot compensate the weak system that we've talked about in terms of designing these layers. So there is need for us to for the public sector, but also in extension the donors, to really think about how can we direct a lot of financing and support within the infrastructure itself and enable the capabilities of risk transfer processes to be credible, but also scalable in a way that it remains accountable to the disaster that we are trying to address. So for instance, where we would want to see the public sector and the donors really putting their hands together is in terms of how then we create data as a public good. I've talked about data being a major issue when it comes to connecting these layers. So there is need for us to think about how then do we improve public data that will be used for modeling and pricing of these risk transfer instruments, but also kind of enabling that data to be shared across different platforms. And that will ensure that there is need for us to put a lot of investment from the public side to allow API integration from different elements and different people that are currently having access or hold these data. The second thing is around institutional capacity. We really need to build the capacity of institutions, and these will require investments from the public, but also the donor or development agencies, whereby as we kind of address the issues that we are currently facing in connecting these layers, then there is enough capacity within the private sector that will be the key drivers of this architecture that we are trying to build. And lastly, from the public sector, there is need for creating an enabling environment, particularly on the regulatory frameworks. I did mention earlier that all of this requires a regulatory alignment. So there is need of coordination of public institutions that have a mandate to ensure that households, institutions, and even the government is protected from these disasters. And that means that that coordination has to be ensured in terms of developing frameworks in ways in which they are going to coordinate and ensure that the risk is managed. But lastly, is around finance. So if you look at it, by government and donors providing premium subsidies that are going to be effective, there's need to think about contingent finance and layering that finance in different structures. So are we likely to see blended finance, whereby there is a role that public sector plays, but also the private sector? Are we likely to see the risks being pooled, because there is need for risk pooling when it comes to climate and disaster risks? And that means that that infrastructure has to be built across the public sector and the private sector. So there's a lot of work that really needs to be done. One, from the data side. Secondly, there's an element around what I mentioned earlier on the institutional capacity, also on the regulatory, and lastly, looking at how then we structure financing for the long run, in which in most of the items that we are currently trying to address across the continent and across the world. Thank you.
Thank you so much, Elias. And I really think you've touched on so many important points, and we were a bit ambitious on our time, and we, hopefully if we can have another opportunity, we'll get into a lot more detail on this. But I know we have a last speaker who has been patiently waiting, so I'm actually going to hand back to Krishnan to take us through the end of the discussion. Krishnan, over to you.
Yeah, so thank you very much, Anar, and thanks, Elias. I think you have provided a lot of food for thought and further discussions. In fact, when you mentioned the importance of blended finance, it was music to my ears, because that's exactly what UNCDF is working on, especially in climate risk insurance. And there are two other points which probably Panay can cover. Thanks once again, Panay, for patiently waiting. So Elias spoke about the coordinated reinsurance at the micro, meso, and the macro level, and also to alignment of triggers both for the macro and the micro. I'll just park that for probably later discussions, but particularly I want to know from you, or from your experience, what can a reinsurance provider like you and private risk capital, where you can add the most value in this whole architecture that we have been discussing so far, particularly in supporting local insurers as well as the risk pools. While local insurers take care of the micro, the risk pools, as we saw, play a very important role at the sovereign level, with parametric solutions, with agriculture risk, or even humanitarian risk finance. Panay.
Thank you, Christian, and thank you for patiently waiting for me. I know I'm the last speaker. But firstly, we're proud to be a reinsurer. In fact, both Anna and Isaac are partners of ours, which we're very proud to both reinsure the CRIF and or the CRIF SPC and the START network. The most fundamental purpose of reinsurance is to take away that systemic risk. Now, whether at the micro, the meso, or the sovereign, and as Anna said, it doesn't really matter. It's still the same event. Different impacts, same event. What we're here to take out is to reinsure what the local market cannot absorb. And that really depends on the local adaptive capacity. What is systemic to one person or one industry or one sovereign or one humanitarian may not be systemic to someone else. So for those really big events, the ones that Isaac described, the ones that are wiping out a significant portion of GDP, the ones that you have to rely on external partners, international institutions for support, that's where reinsurance can provide most value to. But it's not only that. That's the hard reality. Reinsurance is a mechanism of pooling risk, and the fundamental principles of insurance is you pool a lot of independent risks together and you make it more predictable. And that's how reinsurance companies make money ultimately. It's about pooling a lot of independent risks together to make it more predictable. Now, if you're prone to a sub-Saharan Southern Africa drought or a North Atlantic hurricane, you can't diversify that risk. It's something that is systemic to your particular region. That's why the global capacity, the global insuring come in above to support that. But it's not just about providing capacity. It's about leveraging that global expertise. I go back to what Anna said at the start. The local context is really, really important. And as a reinsurer, we want to make sure we're supporting products that work, which means we need to partner with all of our reinsurance, or our clients, from humanitarians to governments to risk pools, to make sure we're understanding how the dollar comes from us all the way to the vulnerable population when it's needed the most. But we do have something to offer in terms of hazard modeling, in terms of data, because it's not just used for pricing purposes. Data and models should be used as part of the entire disaster response process. As both Anna and Isaac correctly pointed out earlier on, it's one part of the process. Insurance does not work in isolation. It is a financial tool to help mitigate the financial impacts of disasters, which is why we look at parametric insurance as well, because sometimes the delivery systems of making sure the money reaches from A to B doesn't exist. It's too slow. So we have to find other innovative ways by looking at data which closely correlates to those impacts. But it's not perfect. Other times systems might also exist. So we want to plug into those systems. That might be because there is good distribution mechanisms through cooperatives or through other actors that we can plug into. We want to ultimately reduce the frictional costs of providing that umbrella, that safety net. So we don't want to be disruptive as a reinsurer. One final point, I'll give you an example that actually brings this to life. Hiscox, along with my peers in the market, Swiss Re, we reinsured or insured the World Food Programme in Syria, a region which you might all think that it's not a huge amount of financial infrastructure. It's been war-torn, it's fragile. There are a certain level of sanctions still in place there. It's really difficult to protect the vulnerable people there. And secondly, it was a peril drought. As mentioned earlier, drought is not a sudden onset peril. It's difficult to model. It's not a huge amount of data is available. But the World Food Programme has been operating there for decades and has a lot of good on-the-ground information, that local context that we discussed. At the same time, there's a lot of good satellite data. So in this case, we use something called the NDVI, the Normalized Differential Vegetation Index, and which closely correlated to that ground truthing, that information that the World Food Programme provided. And by operating through the World Food Programme, which operates under the humanitarian exemption for sanctions and other things under impunity in the particular region, we were able to protect the most vulnerable people in parts of Syria. And last year, in 2025, there was a payout of just under 7 million euros, which reached the people there. So these are a couple of examples, both from a theoretical perspective of being a capacity provider, all the way down to kind of some real examples of how we do structure these programs. So we can provide data and modeling, which can influence the entire chain. We can and ultimately take some of that systemic risk away from the local carrier. I'll pass back to you, Christian.
Yeah, thanks, Panay. So I have another question for you, which is also a subject of discussion in a different forum. So we have seen many one-off pilots, and some of them very successful, but we don't see them really scale and become sustainable. So therefore, what do governments, donors, and public actors need to do to make a private capital participation possible wherever possible, while keeping the focus on public purpose and for protection of the vulnerable people?
That's a good question. And picking up where I left off, often these pilots are sometimes designed in isolation, sometimes from someone sitting in a head office somewhere in an international institution, sometimes without appreciating the whole value chain. Ultimately, when setting off an venture for a pilot, we want to understand who we're trying to protect and who ultimately is going to be the risk carrier. And there's a whole bunch of stuff in the middle there. So when designing in isolation, you risk a pilot remaining a pilot. Next, there's a question of affordability and understanding who is paying. In agriculture insurance, I genuinely believe without subsidy, it's going to be unsuccessful. I don't think there's a single successful scheme long-term in the world at the moment without a government subsidy. Why is that? Well, agriculture is not a glamorous industry. It is subsidized all the way from the US to Malawi. It's in every country around the world. It is of fundamental importance, which is why it links a lot to policy. Insurance could also be viewed as a way of distributing subsidy to those who need it the most and to protect an industry as well. So it's a delivery mechanism rather than an insurance product a lot of the times as well. Now, other things are not, and insurance and resilience have to work hand in hand together. And I won't just say insurance and risk financing needs to work hand in hand. Insurance is good because you could put something together very quickly and provide an immediate need in a year, whereas mitigation and adaptation and building resilience can often take years. If we, the private sector, can see those impacts of mitigations, ultimately, we can credit that in our pricing, in our coverage, and those pilots can scale up. If the hazard is increasing, and we all know the risks are increasing, particularly for perils like drought and flood in the world, and there's no adaptation, and there's no resilience building, and there's no mitigation, then eventually it's going to become uninsurable, and those pilots are not going to scale them. Secondly, we have very little power, very little signals we can send. Pricing is one way we can send a signal. We think the risk is high, therefore we have to charge X amount. Ultimately, the margins insurance companies charge are not huge. It's the view of risk which drives that pricing, and pricing is a way of sending signals to say whether something is sustainable or not sustainable. Thank you, Christian.
Yeah, so thanks, Panay. I think, we have had some very rich and very interesting sort of discussions so far. What is coming out is that each of these layers that we saw, whether it was the micro or the meso and the macro, have their own intrinsic and very critical value, but they cannot operate in silos. So they have to be brought together for a coordinated national response for these increasing vulnerabilities and the impact of climate change that we're all seeing everywhere. So I think from that point of view, whatever points we have seen so far and the responses that we've received are all moving in that direction, that the micro, meso, and the macro has to reinforce each other rather than operating as very separate instruments. In the interest of time, I will hand it over back to Anar to wrap up this session and quickly reflect on what it means for the various stakeholders, the governments, the markets, and the beneficiaries more particularly. Over to you, Anar. Thanks.
Yeah, thank you very much, Christian. And I think I'm hearing, similar things to you, that we can't work in silos. I think for me, a few themes are emerging here that all of our panelists have touched on. But depending on the size of the event and the size of the risk, it might need to be carried by a different actor. Local actors are adapted to carry a certain level of risk. You might need the reinsurance community to come in at a larger level. And also raise the point of, there are certain events where no single actor can carry the risk alone. Elias brought in the point of an ecosystem approach and how different actors need to work together. And I think we heard that as well in our, in our first panel when we saw local insurance companies or central bank authorities working with different government agencies and local delivery channels. So there's a lot of discussion around collaboration and designing an ecosystem approach. And I think another important point that I heard that I do want to stress is that insurance shouldn't work in isolation. We need to work with resilience and adaptive financing to build the kinds of systems that are needed for countries and for vulnerable populations. So you've all been very patient. I know we're over time. There's been a lot of good questions in the chat. Since we're over time, we won't get into them now, but we'll circulate them with our panelists after the webinar, and then hopefully follow up with you with the responses to these questions. I just want to close by giving my thanks to all of our panelists for being here. We really appreciate your time. We really appreciate the depth of your insights. I also want to thank the UNCDF and Krishnan for our partnership that made this webinar possible. And of course, I want to thank my colleagues who behind the scenes made this happen. So Swati, Lamise, Philip, Anand, if you're connected, thank you so much for being here. This is a conversation that we've started here today, but needs to definitely go further. We want to move this from dialogue into action. We want to be able to work with all of our partners online to create the ecosystems necessary to connect these different layers. So thank you very much, all of you, for being here. Thank you for joining us. Thank you for your interest. And we hope to continue these collaborations with you. Thank you very much, everyone. Goodbye.
Bye.
Bye all. Bye-bye.